Monday 9th, 2026. Like and subscribe. The $1 Investor. In today's video, we're going to talk about two scenarios happening in the stock market today. The first one will be how you can accumulate a great foundation for retirement with minimal amounts of capital. The second one is the imminent market collapse being structured by this administration. We've been given an opportunity of a lifetime. We need to take full advantage of this elite's gift to themselves. But us, the educated investor, can do the same as well. Maybe not in the astronomical numbers they will benefit from, but we can still do the same. Watch the full video on my YouTube channel. Remember, I'm not or your financial advisor. Investing comes with risk and you'll probably lose money. So do your own due diligence and research. Good luck. One powerful statistic. If someone invested $10,000 during the worst days of the 2008 crash, that investment would be worth over $70,000 today. The hardest moments in markets often create the best opportunities. Small amounts of money, invested consistently and compounded over time, can grow into significant wealth. 1. You don't need a lot of money to start. Most people delay investing because they think they need thousands of dollars. Our video will argue the opposite. Even tiny amounts can compound. The key is starting early and staying consistent. Compounding turns time into your biggest asset. 2. Consistency beats big deposits. One large investment is not what builds wealth. Wealth usually comes from regular contributions, patience, long-time horizons. Even small investments done daily, weekly, or monthly can grow dramatically over decades. 3. Compounding is exponential. Compounding starts slow. For years, it may feel like nothing is happening, but eventually the growth accelerates because returns generate new returns. Those returns generate even more returns. This is why investors who stay invested the longest usually win. 4. The biggest mistake: waiting. Most people wait for more income, a raise, a better time. But our video emphasizes time in the market matters more than timing the market. And today I want to talk about something that most people completely underestimate: the power of tiny amounts of money. Because most people think you need thousands of dollars to invest. But the truth is, small amounts invested consistently can turn into real wealth. And today I'm going to show you how I'm proving that in real time. Welcome to the channel, The $1 Investor. Like and subscribe. The big lie about investing. The biggest lie people believe about investing is this: I'll start when I have more money. But that moment rarely comes. Life happens, bills happen, emergencies happen, and before you know it, 10 years pass. But here's the truth. Investing isn't about how much you start with. It's about how long you stay invested. The power of small investments. Compounding is one of the most powerful forces in finance. If you invest a little bit of money, and that money earns returns, those returns start earning returns too, and eventually something incredible happens. Your money begins to work harder than you do, but this only happens if you start early, and if you stay consistent. My strategy, my portfolio section. This is exactly why I started the $1 Investor Portfolio, to prove that anyone can invest. You don't need a huge salary, you don't need to be a professional investor, and you definitely don't need to time the market. All you need is discipline and consistency. Every single day the market is open, I invest automatically. Right now, the strategy is simple. Every day I invest $3.57 into each position. Those positions are DGRO, ETHA, IBIT, CLAR, SCHD, SPYM, VT. And I do this in two different accounts: my individual brokerage account and my Roth IRA. Every single market day. No guessing, no emotions, just consistency. Why this matters for working people. This portfolio was designed for the working class, the working man, the working woman, the blue-collar worker. Because most financial advice online is aimed at people making six figures. But that's not reality for most Americans. Many of us are just trying to build stability, build security, build something better for our families. That's why this experiment matters. Because if this works with a few dollars per day, imagine what happens over 20 or 30 years. My personal journey. I've spent years working and building my future, and today I have 3 pensions. One from the UFCW, one from the Teamsters, and one from AC Transit ATU. Those pensions give me security, but investing gives me freedom, because pensions are one pillar, investments are another, and when you combine both, you build real financial stability, or the long-term vision. This portfolio isn't about getting rich overnight. That's not the goal. The goal is something much more powerful. To get rich for sure, slow, steady, disciplined. The same way wealth has been built for generations, through patience and compounding. If you're new to investing, remember this. You don't need thousands of dollars. You just need to start. $1, one day, one investment at a time. This is the journey of the working class investor, and we're just getting started. I ran the math assuming my exact strategy. $3.57 per day per position. 7 positions: DGRO, ETH, IBIT, CLAR, SCHD, SPYM, VT. 252 trading days per year, 5 years. Dividends automatically reinvested, included in total return. 2 growth scenarios, 5% and 7% annual return. My daily investment system. Per day I invest $3.57 times 7 positions, $24.99 per market day. Per year, $24.99 times 252 equals $6,297.48. Over 5 years, total invested, $31,487.40. Per position breakdown, 5 years. Each fund receives $3.57 per day, $899.64 per year, $4,498.20 invested in 5 years. If the portfolio averages 5% annually, value per position after 5 years, $5,110.85. Profit per position, $612.65. If the portfolio averages 7% annually, value per position after 5 years, $5,386.47. Profit per position, $888.27. Total portfolio value, 7 positions. If returns average 5%. Total value, $35,775.95. Total invested, $31,487.40. Total profit, $4,288.55. If returns average 7%, total value, $37,705.29. Total invested, $31,487.40. Total profit, $6,217.89. What makes my strategy powerful? My system has 3 compounding engines working simultaneously. 1 daily dollar cost averaging. I buy every market day regardless of price. 2 dividend reinvestments. Funds like SCHD, DGRO, SPYM, and VT are constantly paying dividends. 3 market growth compounding. This creates layered compounding, which is exactly what long-term investors want. The hidden power, the part most people miss. The first 5 years look small, but once the snowball starts rolling, growth accelerates. Now let's talk about the storm coming and how we profit from the market collapse. But what do I know? I'm just a blue-collar working bus driver who's seen this episode at least 3 times already. I benefited from this type of market before, and I will again. The video's core message is that market crashes are not just disasters, they are wealth transfer events. During a collapse, panic investors sell assets at extremely low prices. Patient investors buy those same assets at massive discounts. Over time, when the market recovers, the investors who bought during fear often build the largest wealth. Our video emphasizes that most people react emotionally during crashes. Fear, panic selling, pulling money out of the market. But historically, the largest fortunes were built during market crashes, not during bull markets. The key idea: crashes transfer wealth. Every market collapse creates a transfer of assets, from unprepared investors to prepared investors. This happens because markets become irrational during panic. Good companies can suddenly trade 30%, 70% below fair value. Investors with cash, discipline, patience can buy those assets extremely cheaply. Historical examples of wealth built during crashes. The Great Depression, 1929. The market fell almost 90%. Investors who bought during the Depression made enormous returns when the market recovered. Example: John Templeton bought 100 shares of every company trading under $1. Many years later, he multiplied 10 times to 100 times. The 1970s market crash. The S&P 500 lost about 50%. Investors who bought companies like Coca-Cola, Johnson & Johnson during the crash built long-term fortunes. The dot-com crash, 2000-2002. Technology stocks collapsed, but companies like Amazon, Apple, became some of the greatest investments ever for people who bought after the crash. The 2008 financial crisis, the market dropped over 50%. Investors who bought during 2008-2009 saw massive gains. Example, S&P 500 in 2009 dropped to about 666. S&P 500 today is well over 5,000. That's roughly 7 to 8 times growth. Why crashes create opportunity? Markets collapse for 3 main reasons. 1. Liquidity panic. People need cash and sell everything. 2. Fear. Investors believe the system will collapse. 3. Forced selling. Funds, banks, and institutions are forced to liquidate. This causes temporary mispricing. Great companies suddenly become cheap. What smart investors do during crashes. 1. Keep buying. Instead of stopping investments, they increase purchases. Example, dollar cost averaging. Exactly what my strategy already does. 2. Buy quality companies at discounts. Investors look for companies with strong balance sheets, consistent profits, global demand. These companies usually recover first. 3. Reinvest dividends. During crashes, dividend yields rise. Example, a stock paying a 3% dividend may suddenly pay 6 to 8% because the price fell. Reinvesting those dividends accelerates compounding. 4. Stay invested. The biggest mistake investors make is selling during the crash. Historically, the biggest gains occur right after the bottom. Missing those days destroys returns. Why my strategy actually works well during crashes. My daily investing system is extremely powerful in downturns. I invest every market day, regardless of price. That means when markets crash, I automatically buy more shares at cheaper prices. Example, if a fund drops 40%, my same $3.57 buys 40% more shares. When the market recovers, those extra shares compound. Example, using my strategy. If my portfolio drops 40% during a crash, my daily buys accumulate significantly more shares. When recovery happens, my portfolio can grow faster than someone who waited. This is exactly why disciplined investors benefit from downturns. The psychological advantage. Market crashes reward people who can control 3 emotions: fear, greed, impatience. Most investors fail here. That's why wealth transfers from emotional investors to disciplined ones. Or the truth, most people don't realize. Bull markets feel good, but they are not where the biggest wealth is created. The biggest wealth is created when investors buy during panic, fear, pessimism, then hold during recovery. Why my channel message is actually powerful. My strategy represents something very important: working class investing discipline. I'm not timing the market, chasing hype, gambling on stocks. I'm doing something historically proven: consistent investing, compounding, patience. One powerful statistic: if someone invested $10,000 during the worst days of the 2008 crash, that investment would be worth over $70,000 today. The hardest moments in markets often create the best opportunities. Market crash opportunity, plus my hedge strategy. And today we need to talk about something very important, something that most investors don't understand until it's too late. Market crashes are not just disasters. They are wealth transfer events. Like and subscribe, The $1 Investor. The truth about market crashes. Most people believe market crashes destroy wealth, but that's not actually what happens. Market crashes transfer wealth from emotional investors to disciplined investors. When markets collapse, people panic. They sell good investments at terrible prices, and those assets get picked up by investors who stayed calm. History shows that the biggest fortunes in markets are built during crashes, not during bull markets. History proves this. During the Great Depression, the market fell almost 90%, but investors who bought during the collapse built generational wealth when the market recovered. During the 2008 financial crisis, the S&P 500 dropped more than 50%, but investors who bought during that panic saw their investments multiply several times over the next decade. And every crash in history has followed the same pattern: fear, panic, selling, and then recovery. The opportunity most people miss. Right now, we are entering a period of massive economic change. Automation, artificial intelligence, robotics, global competition between nations. Governments are investing billions into technology and manufacturing. And at the same time, markets are becoming more volatile. That volatility creates opportunity, but only for investors who prepare ahead of time. My strategy: prepare before the crash. My strategy: prepare. This is why I built the $1 investor portfolio. To prove something very simple, you don't need a huge salary to invest. You don't need to be a professional investor, and you don't need to perfectly time the market. All you need is discipline and consistency. Every single day the market is open, I invest automatically. $3.57 into each position, every day, into these investments: DGRO, ETHA, IBIT, KLR, SCHD, SPYM, VT. And I do this in 2 accounts: my individual brokerage account and my Roth IRA. No emotions, no guessing, just consistency. Why I added hedge positions. Now recently I added something new to the strategy: hedge positions, because when markets fall, volatility rises. And certain investments benefit from that volatility. These include funds like SQQQ, SVIX, SVXY, VIXX, UVXY. These funds are designed to move differently from the market. These I don't recommend to anyone. You want to lose money? These are the funds to do it with. I'm not a or your financial advisor. Do your own due diligence and research. Investing comes with risks, and you will probably lose money. Back to our video. Some rise when the market falls. Some rise when volatility spikes. These are not long-term investments. They are tools for protection during extreme market conditions. They help hedge against a crash. My Roth IRA portfolio. Right now, inside my Roth IRA portfolio, we're seeing something interesting. The portfolio is currently sitting around $28,000, with gains of over $5,000. And some of the positions that have performed the strongest recently are the volatility funds: UVXY, VIXX, and SQQQ. These are exactly the types of funds that move when markets get unstable, which is why they can act as insurance during downturns. Why this matters for the working class. This portfolio was designed for the working class, the working man, the working woman, the blue-collar worker, because most financial advice online is aimed at people making 6-figure salaries. But that's not reality for most people. Many people are just trying to build a secure future, build stability, build retirement, and that's exactly what this strategy is about. My personal journey. I've spent years working and building my financial foundation. Today I have 3 pensions, one from UFCW, one from the Teamsters, and one from AC Transit ATU. Those pensions create security, but investing creates freedom, because pensions provide stability, but investments provide growth. And when you combine both, you build real long-term wealth. The real opportunity. If a major market crash happens, the goal is not to panic. The goal is to stay disciplined, because during a crash, something incredible happens. The same investments you've been buying every day suddenly become cheaper. Your money buys more shares. Your dividends buy more shares. And when the market eventually recovers, those shares compound faster. This is how disciplined investors build wealth. The long-term vision. This portfolio isn't about getting rich overnight. That's not the goal. The goal is something much more powerful: to get rich for sure, slow, steady, disciplined. The same way wealth has been built for generations, through patience and compounding. Closing summary. Market crashes will happen. They always have, and they always will. But for investors who stay disciplined, those crashes become opportunities. $1, one day, one investment at a time. This is the journey of the working class investor. Like and subscribe. The $1 investor. Below are the 5 warning signals that historically appear before major market crashes. These signals showed up before the Great Depression, dot-com bubble, global financial crisis, the COVID-19 market crash. No one can predict the exact timing, but the pattern repeats. The 5 warning signs before a market crash. 1. Extreme market valuations. When markets become historically expensive, future returns shrink and risk increases. One of the most famous valuation indicators is the Shiller-Cape ratio. Historically, average CAPE equals 16 to 18. Before crashes, it often rises above 30. Before the 2000 tech crash, CAPE hit 44. The 2008 crisis CAPE was above 27. High valuations don't cause crashes immediately, but they make the system fragile. 2. Rapid interest rate increases. When central banks raise rates quickly, borrowing becomes expensive. The most important player here is the Federal Reserve. Higher rates impact mortgages, corporate debt, credit markets, stock valuations. Historically, many crashes happened after aggressive rate hikes. When cheap money disappears, bubbles begin to pop. 3. The yield curve inverts. This is one of the most reliable recession indicators. The yield curve normally slopes upward. Long-term interest rates should be higher than short-term rates. But when the curve inverts, short-term rates become higher than long-term rates. This has preceded every U.S. recession since 1955. Markets often crash 12-18 months after inversion. 4. Rising volatility. Before major market declines, volatility begins increasing. The most famous measure is the CBOE Volatility Index, commonly called the Fear Index. When investors become nervous, options trading increases, hedging increases, volatility spikes. That's where my hedge positions come into play. Funds tied to volatility include UVXY, VIXY. These tend to spike during market stress. 5. Investor euphoria. Right before many crashes, optimism becomes extreme. You start hearing things like, stocks only go up. This time is different. Everyone should be investing. This kind of herd psychology often signals a late-stage bull market. Markets collapse when there are no new buyers left. How my hedge positions fit into this. I added several instruments designed to move during stress. These include SQQQ, SVIX, SVXY, UVXY, VIXY. Each one behaves differently. Market crash hedge. SQQQ moves opposite the Nasdaq. UVXY, VIXY spike when volatility explodes. Volatility normalization. SVXY, SVX benefit when volatility falls again. This creates a volatility cycle strategy. Crash plus volatility spikes plus hedge rises, recovery plus volatility falls plus other positions rise. Why my core portfolio still matters. My main strategy still focuses on long-term growth through diversified funds like SCHD, DGRO, VT. These are designed for decades of compounding. The hedge positions are short-term protection tools, not permanent investments. The big lesson for you: most investors do one of two things wrong during crashes. 1. They panic and sell. 2. They try to predict the exact bottom. Disciplined investors do something different. They continue investing, accumulate shares, stay diversified, control emotions. Over time, that discipline compounds into wealth. Why my message is powerful. My channel shows something most finance channels ignore. I'm a working-class investor building wealth slowly and consistently. I'm combining 3 pensions, long-term investing, disciplined daily contributions. That's a blueprint many people can actually follow. Like and subscribe, The $1 Investor.